Welcome to Finance Decoded. In this video, you will learn about the instant access and notice savings accounts, fixed rate bonds, and regular savings accounts, including how the accounts work, what are the tax implications, whether your money is protected, and finally, what are the pros and cons. This video is part 2 of the Ultimate Guide to UK Savings Accounts series, where we will cover the following savings accounts. Click on the timestamps in the description box below to skip directly to the savings account of your choosing, and click on the link above to watch the rest of the series where the other accounts are explained. As the name suggests, easy access or instant access savings accounts provide you with immediate access to your money. Generally, you can open an account with as little as £1 and can make deposits and withdrawals whenever you like and free of charge. However, there are some providers that may limit the amount of withdrawals per year. You have to pay tax on any interest earned above your personal savings allowance. To learn more about the personal savings allowance, watch part 1 of this series linked above. If your savings account is with a UK regulated bank or building society, you will be protected by the Financial Services Compensation Scheme up to £85,000, which means if your bank or building society goes bust, your money is protected up to this amount. The main benefit of this savings account is being able to access your money quickly. You can also save at your own pace as no regular payments are required and a very small initial deposit is required. However, as interest rates are still low and around 1 to 1.2%, inflation will devalue your money. So what should you use this account for? As your money can be accessed with ease, this is a great account to use as your emergency fund. With the Notice savings accounts, you can make deposits whenever you like, but when you want to make a withdrawal, you are required to give notice in advance. This is generally between 30 to 120 days. You have to pay tax on any interest earned above your personal savings allowance. If your savings account is with a UK regulated bank or building society, you will be protected by the Financial Services Compensation Scheme up to £85,000. A benefit of a Notice account is that they tend to have higher interest rates than the easy access accounts, and you can make deposits when you like. Also, because you need to give notice, this may deter you from spending impulsively. However, having to wait to withdraw your money may be an issue, especially if an emergency arises. And in the event your bank or building society does allow you to withdraw earlier, it's likely you'll face a penalty in the form of lost interest. And lastly, notice accounts often require a minimum balance around £1,000. So what should you use this account for? If you have a specific savings goal, such as a holiday next year or a home renovation, this is a useful account to use, as you can continue saving towards your goal at a higher interest rate and you're less likely to make impulsive withdrawals. The next type of savings account is the fixed rate bond. With fixed rate bonds, a lump sum is deposited for a set period of time, usually between 1 to 5 years. During this time, your money cannot be withdrawn. Like the instant access and notice savings accounts, tax is paid on any interest earned above your personal savings allowance. And if your savings are with a UK regulated bank or building society, they are protected up to £85,000 by the Financial Services Compensation Scheme. The advantages of this account are that the interest rates tend to be higher than the instant access and notice accounts. Many rates are currently over 1.5%, so your money is less likely to be devalued by inflation. And for the most part, the longer the bond term, the higher the interest rate. Some providers also increase the interest rate if you deposit more money. Additionally, your interest rate is fixed, so if rates decrease, this won't affect you. Whereas with an instant access and notice savings accounts, interest rates tend to be variable, so will be affected. However, if interest rates rise, you will lose out as your money is stuck in a bond for a set period of time, so you cannot switch to a savings account with a higher rate. Another drawback is no additional deposits are allowed or withdrawals until the bond matures. So what should you use this account for? Fixed rate bonds are good for long-term savings, such as a wedding in several years, or maybe a deposit, and great to lock in your money at a fixed rate, especially if you believe interest rates may fall. Regular savings accounts require you to save a specific amount of money each month, usually between £10 to £500. You'll have to pay these payments until the term ends, and terms typically last for 1 year. To set this account up, you usually need to already have a current account or open a current account with a bank or building society you want to open your regular savings account with. Like the other savings accounts, you have to pay tax on any interest earned above your personal savings allowance. If your savings account is with a UK regulated bank or building society, you will be protected by the Financial Services Compensation Scheme up to £85,000. So what are the benefits of this account? The interest rates of regular savings accounts tend to be higher than the instant access, notice savings accounts, and fixed rate bonds. Regular savers are also a great way to build up your savings as you get into the habit of saving regularly. Additionally, for those who are new to saving, it can be an attractive option as you are not required to deposit a lump sum. However, there are several restrictions which make this account less favourable. Generally, regular savings accounts have a low maximum deposit limit, usually around £3,000. So if your balance goes above this limit, the interest earned is significantly less. Also, withdrawals may be restricted until the end of the term. And if you miss a payment, you may be penalised, for example, by a reduced interest rate, or your account may be closed. Additionally, some providers will not allow you to change the amount you pay per month. So if you want the flexibility to increase or decrease payments, this is not the best option. So what should you use this account for? The regular savings account is useful for building up your savings and a convenient way if you're saving up for a specific occasion, such as a holiday or a birthday over a period of time. So that's part 2 of the ultimate guide to UK savings accounts. Thanks for watching Finance Decoded and stay tuned for part 3. If you enjoyed this video, then give it a like. Want more? Subscribe below. Thoughts? Comment below and leave suggestions of videos you want to see next. See you in the next video.